In the modern financial landscape, traditional human execution has been replaced by hyper-fast automated systems. Within the millisecond it takes to click a mouse, algorithms can execute thousands of discrete operations. To survive in this cutthroat environment, quants look at the market through the lens of systematic engineering. Success requires separating bad luck from a fundamentally broken execution process.
A PhD particle physicist turned 8-figure futures trader, consistently beating the market for the last 30 years. In this episode, Samir reveals how in designing algorithms, he discovered that market manipulations are just hidden iceberg orders, and how a leech on the whale strategy is the best way to catch a ride alongside the market movers.
Liquidity of the stock market at any given instant in time is not very big.
Transitioning from particle physics to quantitative trading requires an absolute focus on hard, logical rules. In this game, emotional intuition is a liability. Institutional funds cannot simply buy or sell millions of shares without moving the market against themselves. To avoid this, they use sophisticated algorithms that disguise their large orders across multiple exchanges.
Introducing Rishi Narang, co-founding one of the most secretive quant trading firms in all of Wall Street, trading $750 million. He wrote the de facto Bible on how market algorithms work, and in this episode he pulls back the curtain on the realities of market manipulations and how price really moves, highlighting the real goals of smart money.
If you're a retail trader and you've engaged some new approach and it's given you 3 correct answers in a row, that literally means nothing.
When institutional players enter or exit positions, they leave a unique mathematical footprint. Predictive algorithms spend every microsecond searching for these exact patterns. High-frequency systems are programmed to seek out clusters of public resting orders. By temporarily driving prices into those zones, they force liquidations and capture immediate spreads.
Makers and hunting stops. There's a big thing in the retail space of like price hitting your stop loss, then going completely the other way,
Correct.
and people feeling very targeted. I've heard you say that that is a case, that is something that does take place.
Yes, you're 100% right. I started focusing on the algorithms a very long time ago. It wasn't my will, I was an agent. Algorithms are there to create volatility and liquidity. They want to travel.
Retail traders often look for predictable chart patterns, making them easy targets for predatory algorithms. The market mechanism is inherently designed to exploit those predictable habits. In the ultra-low latency arena, geographic proximity to the exchange's matching engine is everything. Even the physical length of a fiber-optic cable can determine who wins or loses a trade.
Maybe 2009, suddenly high-frequency trading, which had been a low-profile activity until then, got into the news, and I just thought, hey, that sounds interesting. I'd like to find out more about that. So that's really what got me started.
Yeah, perfect. I think you explain it very well in the book, but for the audience, what is high frequency trading?
The pursuit of millisecond advantages has completely redefined proprietary trading structures globally. If you are slow by a fraction of a blink, you do not exist. Behind the simple buy and sell buttons on a retail app lies a complex labyrinth of order routers. This structural plumbing can introduce subtle structural friction for ordinary participants.
I've had market expert Joe Saluzzi on this program to explain the huge but hidden world of high-frequency trading algorithms, payment for order flow, and dark exchanges. In general, they confer an unfair advantage to the institutions that wield them and oftentimes result in outcomes that impair the prospects of regular retail investors like you and me. Well,
retail traders operate with zero visibility into the actual order routing mechanisms that handle their capital. The unseen plumbing of the market dictates the true cost of execution. The modern stock index is far more than a collection of large companies. It is a mathematical abstraction driven by automated rebalancing loops that interact with market liquidity.
The mountains to follow the vicissitudes of the Dow Jones index. So what you see, that precipice, that high precipice with the valley, is the 2008 financial crisis. The photo was made when we were deep in the valley over there. I don't know where we are now. This is the Hang Seng index for Hong Kong, and similar topography. I wonder why.
Modern algorithms do not merely observe market reality, their continuous high-volume iterations actively reshape it. Math is the invisible architect of modern asset pricing. Academic researchers and regulators continue to debate the systemic value of high-frequency trading. The core question is whether these firms provide real market stability or simply extract rent from slower investors.
Basically came out as a result of the ongoing debate amongst regulators, market participants, and academics about whether high-frequency trading is good for our financial markets, okay, which we heard from Sean as well as from the presentation last night, or the discussion last night.
While some evidence points to tighter bid-ask spreads, other studies highlight the invisible tax imposed on slow players. The true social utility of HFT remains highly contested. High-frequency trading firms pay massive premiums to place their servers inside the exchange's actual data facility. This practice, known as colocation, minimizes physical propagation delay.
Domain, you need best set of hardwares. Now, to win an F1 race, you also need a very good driver. I mean, in fact, an extraordinary or the best driver. Similarly, to win in high-frequency trading, you need the best set of traders or the best set of trading team. And apart from that, you also need, people who are able to build that car, maintain that car. I mean, during pit stops, you might have seen how fast they try to replace the tires and all those things. So similarly, you need, in a high-frequency trading domain, you also
co-locating servers inside the exchange facility is the absolute baseline requirement for low-latency trading. If your server is down the street, you've already lost. Optimizing execution code requires an intimate knowledge of low-level machine architecture. The technical challenge of pushing billions of instructions per second mirrors the engineering required in modern gaming engines.
The C++ committee, there was the idea we should have a study group to see what we could do for video games industry. So we had a study group, and in the first meeting it was called Video Games. Then we had very soon to rename the group, because people from finance started to say, hey, all the things that you are proposing for video games, they are...
Achieving ultra-low latency requires systematic management of software complexity down to the compiler level. Every wasted line of code is an expensive microcell loss. Standard multi-thread programming relies on system locks that can pause execution pipelines. To avoid this latency penalty, HFT systems implement specialized lock-free data structures.
In the question, the three command line input says that first is the string ABCDFGHIJ. It can be any string. A sample input is the string is ABCDFGHIJ. Then a character count, which is 3 in this case, and the number of threads, which are 4. Now these 4 threads will execute and print the characters of the string. How would these...
Implementing lock-free programming constructs ensures that processing threads execute without causing costly execution delays. Efficiency at the nanosecond scale demands custom memory architecture. Successful systematic trading models do not rely on simple chart indicators or subjective opinions. Instead, they leverage rigorous statistics to identify persistent, non-redundant behavior in order flows.
High-frequency trading firm, though you might be surprised to hear he started out on the exact same path that many retail traders do. His name is Dave Bergstrom. Dave is someone who I've followed on Twitter for quite some time. He always has interesting things to share, and I've had the pleasure of speaking with him numerous times also. Now, the thing that I think makes Dave quite unique from most traders who have been on this podcast previously,
relying on objective, evidence-based data helps quantitative traders move completely away from subjective chart reading. If a pattern cannot be mathematically proven, it cannot be traded. While automated trading dominates the landscape, understanding the mechanics of manual execution remains highly valuable. Experiencing the pure speed of order execution by hand provides deep insight into liquidity dynamics.
Feature of this episode is an interview I did with Michael Katz. Michael is an active day trader and swing trader, and he's also the managing partner / co-founder of a New York City prop firm, 7 Points Capital. One of the things which struck me about Michael is the sheer amount of volume which he trades, which is most impressive due to the fact that he's trading by hand without the assistance of algorithms.
Witnessing massive market volume directly builds an intuitive understanding of how liquidity behaves under pressure. Even in an automated world, understanding human panic is vital. Transitioning from standard discretionary strategies to a fully automated workflow requires extensive historical validation. Models must be stress-tested across numerous distinct market cycles.
Founder and lead developer of the trading systems found on his site algorithmicfutures.com. Kyle has over 10 years of experience in a variety of investment roles, including investment banking, private equity, and hedge fund research. Prior to founding Algorithmic Futures, Kyle led alternative manager research at Jackson National Asset Management. Kyle and I cover many important topics on the development of algorithmic trading in futures, including his early experiences in developing strategies in R and Python.
Backtesting a portfolio of uncorrelated strategies is key to managing risk during high volatility events. A strategy that cannot survive historical simulations will certainly fail in production. Low-latency systems capture real-time market updates via specialized UDP multicast feeds. The systems use custom network cards that process incoming data directly in hardware.
Stocks every second. The first step in an HFT pipeline is receiving market data, the real-time feed of prices, volumes, and order book updates from stock exchanges like NASDAQ and NYSE. But we are not talking about your everyday API or WebSocket feed. HFT systems use multicast feeds directly delivered over ultra-low latency networks, often inside a co-location facility.
Bypassing the standard operating system kernel allows the system to process incoming packets in microseconds. In HFT, standard network software is far too slow. Removing human intervention from live execution is critical to preserving strategy integrity. When unexpected market volatility occurs, the algorithm must execute its rules without second guessing.
Street that are using mathematics to make short-term predictions in the financial markets. And I said, ooh, that's interesting. And then it used the buzzword chaos theory. And I said, ooh, double ooh, because I'd published in chaos theory as a graduate student. And I said, this is fun. I'd read a lot of economics. So I said, well, this sounds like nonsense. We know the efficient markets hypothesis. This can't possibly be true. And of course, I didn't have a job.
A systematic trader must accept short-term losses as part of the overall mathematical model. Overriding a validated system based on fear is the quickest path to ruin. Retail brokerages that advertise zero-commission trading typically make money by selling their customer orders to market makers. This mechanism is known as payment for order flow.
I've been running my own thing for more than 20 years now. And in that time, there have been exactly 3 times that I actually intervened and took risk down to zero.
Does this imply black swan events or external factors that cannot be predetermined can be systematized?
Wholesale market makers profit from the bid-ask spread by internalizing this non-toxic retail order flow. Free trading apps are never truly free. You pay with your execution data. Succeeding in professional high-frequency market making requires a flawless understanding of Q mechanics. Firms constantly optimize their order placement to capture exchange rebates.
What were the mindset going into trading, especially at that time? The New York Stock Exchange as well.
Yeah.
Where was your mindset? Why trading in the first place?
It's pretty amazing. First of all, I thank the good Lord because I couldn't have carved out a better situation for myself without really knowing what I was doing.
Professional traders leverage execution speed to gain priority placement within the limit order book. Q position is the difference between capturing a profit and being left behind. To achieve absolute maximum velocity between distant markets like Chicago and New York, firms construct expensive microwave transmission networks. These networks send signals over the air in a straight line.
That high-frequency trading takes place in, so the ones in New Jersey are where shares and foreign exchange are traded. So the link between Chicago and New Jersey can't get that much faster than...
The extreme competition for speed has led to diminishing returns as algorithms approach the absolute speed of light. Shaving off a single nanosecond now costs millions. Global asset prices are continuously pushed and pulled by central bank policies and interest rate updates. Systematic algorithms must carefully monitor these macro signals to avoid being caught on the wrong side of a structural trend.
Trading LLC, a leading independent agency brokerage firm that trades equities for institutional money managers and hedge funds. He's also the co-author of the book Broken Markets: How High-Frequency Trading and Predatory Practices on Wall Street Are Destroying Investor Confidence. Joe, it's so good to see you again, my friend. Thank you so much for...
Quantitative systems must dynamically adapt to massive liquidity flows driven by central bank interventions. Trying to fight the Federal Reserve's primary policy trend is a losing battle. Large institutional investors, such as corporate pension funds, must be incredibly careful when rebalancing their holdings. If they execute a large order all at once, predatory algorithms will immediately drive the price up.
This big, massive thing, and you could turn it into a million little things, something like a flock of birds. Well, then the radar that's looking for that has to be able to see every flock of birds in the sky. And if you're a radar, that's a really bad job. And he said, yeah. He said, but that's if you're a radar.
Slicing and dicing massive orders prevents immediate price impact, but creates distinct patterns that pattern matching algorithms track. The market is an ongoing game of institutional hide and seek. The technology gap between high-frequency execution firms and smaller discretionary funds continues to widen. Slower players face severe adverse selection when entering the public order book.
They detect that this trade is taking place, they are going to compete with the institution to trade in the same direction. Why might they want to do this? Well, if I know that someone is going to trade a large part...
Squeezing execution times down to nanoseconds restricts the viability of manual trading strategies. In the modern market, competing without technological leverage is an existential risk. While traditional fiber-optic cables are highly reliable, light travels slower through glass than it does through empty space. This physical limitation makes microwave arrays superior for ultra-fast communication.
Call to use and all those things are actually decided by the exchange only. It's not decided by the market participant. Now, as you may know, like let's say for market data or for order entry, whichever protocol is used, underlying transport layer protocol, let's say it's UDP or TCP, it would eventually be encapsulated in IP datagram, which is a layer 3 protocol. And by layer 3, I'm referring to the 7 layers of the OSI model. And that IP datagram will be eventually encapsulated in a layer.
Switching to microwave arrays allows signals to travel through the air closer to the true speed of light. In the low-latency arena, physics is the ultimate boundary. Writing high-frequency trading applications in C requires a strict focus on memory management. Engineers use advanced semantic move operations to transfer data without expensive memory allocations.
The whole presentation is basically just a collection of some hacks, approaches, know-hows, and things that we have in our code base that we actually use in production to make our code run faster. Some of this stuff is completely unrelated to finance, trading, exchanges. Some it is a little bit related. You don't have to know basically anything.
Eliminating unnecessary allocations in the execution path keeps system latency entirely deterministic. When code is optimized perfectly, performance variations disappear. Traditional thread synchronization mechanisms cause the operating system to put thread processes to sleep. High-frequency architectures bypass this by utilizing atomic variables and hot spin locks.
Threads in a sample input there were 4, and we need some kind of synchronization between these threads. Like one thread will execute, it will do some work, the next thread has to pick up from the point where the thread 1 left, and it will again do some work, and that work here is actually printing the characters of the string, and so on. So how we can basically induce synchronization between in this particular workflow?
Deterministic execution is achieved by keeping threads hot spinning until their specific turn occurs. Forcing a thread to sleep is a latency disaster. For modern quantitative traders, proficiency in programming languages like Python or C is not negotiable. Code allows researchers to backtest hypotheses against terabytes of data efficiently.
At the very beginning, what was your introduction to trading? How did you start out?
Oh, geez. So actually back in undergrad, I was on track to go to law school, and about halfway through realized that I wanted nothing to do with law school. So I kind of searched around for, other things that, maybe I could pick up and change careers with, halfway to go in school.
code acts as a massive force multiplier, allowing a single trader to analyze vast datasets systematically. A modern trader is a software engineer with an understanding of risk. Proprietary firms frequently route complex orders through private execution spaces called dark pools. These venues hide trade intent from the public market until after execution is complete.
Holiday was great. Lots of cold up here in New York, so we ended up staying in for New Year's. But it was nice. The kids stayed up, and some family came over, and ended up being a blast.
Very nice. How many kids do you have?
I got three kids, 2 boys and a girl. I call it 2 bodyguards and a girl.
Interacting with block liquidity in dark pools allows large institutional orders to execute with minimal market impact. Navigating these hidden venues requires highly customized execution logic. Building an algorithmic trading model requires a strict walk-forward validation methodology. Researchers must confirm that their strategy rules perform well on unseen historical data.
At the time, prop trading firms were moving from using discretionary traders to really just hiring programmers. So I wasn't able to break into prop trading right out of undergrad, but it was a pivotal shift in the industry. And so I gained a lot of interest in automating trading and kind of recognized that I needed to develop a skill set to become an algorithmic trader versus
Curve-fitting historical noise is the absolute easiest way for an automated strategy to fail in live markets. If your model is over-optimized, reality will break it, because an unchecked algorithmic loop can bankrupt a firm within minutes. Every order must pass through automated hardware risk checks before hitting the public matching engine.
And sell orders. HFT systems maintain this entire order book in memory to avoid any disk I/O or database latency. It's updated in real time with every incoming message triggering a precise update. In most systems, you'll see replicated order books like replica A and replica B, kept in sync using in-memory replication. This ensures fault tolerance. So if one replica crashes or lags, the system can instantly fail over to the other.
Risk engines verify order size and trading limits within microseconds to prevent runaway algorithmic loops. Safety filters must be lightning fast to preserve performance. The work of a quant firm is never truly complete. Every execution must be carefully compared against historical benchmarks to ensure the strategy is capturing its expected edge.
If you're holding a position overnight, do you get nervous? Can you sleep?
Yeah.
So then you would need to scalp or day trade.
Mm-hmm.
The second question is, if you've had a bunch of losses in a row, do you freak out? Or can you handle that?
I think I'm pretty good at handling
You're pretty good at handling that. So you're probably, in that case, just those 2 questions already suggest that you could probably do intraday trend following.
Yes.
And most likely the place that you would probably want to do this is opening range breakouts, which are fairly successful.
Consistent execution is the direct result of constant mathematical refinement and rapid adaptation to changing market dynamics. The moment you stop optimizing, your edge begins to decay. The low-latency financial battlefield is locked in a state of continuous evolution. As computing hardware improves, algorithms grow more sophisticated, creating an ultra-competitive environment.
You said something that wasn't about this, but it absolutely is about this in the end, which was come up with like a trading plan before you do the trade. Like write down your reasons for doing the trade. And then afterward, do an autopsy and say, okay, did the thing go as I expected it to go? What went the way I thought it would? Where did I just get lucky? Where did I get unlucky? But my reasoning was right a priori. Okay.
The modern marketplace is entirely dominated by these digital systems which shape the flow of global capital. Understanding this code-driven architecture is no longer optional. As technology advances, the underlying complexity of financial execution pipelines continues to surge. For serious market participants, looking beneath the surface of the electronic book is essential.